Hello and welcome to Dollars and Cents, the Australia Institute podcast where we're talking about just what the hell is going on in the economy. I'm Elinor Johnston-Leake, the senior content producer here at the Australia Institute, and as always, I'm joined by our chief economist, Greg Jericho. Hi, Greg.
Hi, Elinor.
How are we going today?
Very good. Very good.
So, Greg, in the news this week, the federal government has announced it will fund a pay rise for early childcare workers.
Thousands of parents are being left without childcare, with understaffed centres unable to keep up with demand.
It is so prohibitively expensive. Too many children miss out because it's expensive. And then we've got too many children arriving at school behind because they haven't got the early education they need.
There's a fresh cost of living relief on the way this morning with some major changes to the price of childcare.
The government-funded pay rise of over $50 a week can apply to as many as 200,000 workers or more, a cost of $3.6 billion over 2 years.
Childcare centres need to essentially promise that they won't increase fees for families by more than 4.4% over the next year.
What we know is that during the pandemic, these are people who kept Australia and our economy going, and they deserve more than our thanks. They deserve decent wages and conditions.
The announcement is for a 15% wage rise over 2 years, so that's 10% in December this year and another 5% in December next year. And it will cost $3.6 billion. Will this have a big effect on the childcare sector?
Yeah, it's much overdue. Really welcome news for people in the childcare sector and for anyone with kids who values childcare, because childcare, along with aged care, has been one of the lowest paid occupations around. It really is undervalued compared to, say, how we pay teachers.
Yeah, and considering it's very essential work.
Yeah, absolutely essential. It's not only delivers great benefits for children and helping them socialise and get their sort of education started early, it's also really important for the economy because it allows people to work while they've got kids. You know, they don't have to, and this was especially women, leaving the workforce for, say, 5 years. And you think about that 5 years of lost superannuation, 5 years of lost promotion experience and all of that. This is a really good move because it kind of addresses the lack of funding for childcare workers that we've seen. So people might think about it and go, 15%, wow, that's a real lot of money. But it's, again, they're coming off a really low base.
Yeah.
So it's about addressing the problem of low payment. It's kind of righting past wrongs.
Yeah, so a great announcement then. And we talked a bit last week about whether the RBA would keep interest rates on hold. And obviously they listened and took your advice and they did keep rates on hold. Is there a concern that this would contribute to inflation?
No, you're going to hear this a bit, but really no. One, because again, it's coming off a low base. So it's not like there's going to be, say, teachers who are going to go, wow, childcare workers have got a 15% pay rise. They're doing really well. No, they're going to look at the pay that childcare workers are going, and I'm pretty happy with what I'm getting as a teacher or something like that. So it's not going to have, I think, a carryover impact on wages because the competing sectors for those workers are not going to have to match it to sort of, keep people in their sector. And also the government has made it very clear because they're the ones footing the bill for this increase in pay. It's only going to go to workers in childcare centres that are also agreeing to limits on the amount they're able to increase their childcare fees. So there's about a 4%, a bit over 4% in annual increase in fees that it's sort of capping, which again is showing that governments actually can have a role in keeping inflation down. They're saying, hey, we're going to foot a bit of the bill for your childcare workers, but in reply, you've got to make sure that you're not going to take advantage of this and, set fire to childcare fees, which would have an impact on inflation.
Yeah. So government can target their spending in a way that wouldn't increase inflation.
Yeah, governments can actually do significant things to reduce inflation or to, in this case, sort of temper inflation, ensure that childcare fees do not rise astronomically. It keeps a lid on it. But it also, at the same time, is addressing the real underpayment of childcare workers, the real undervaluation of them. This enables childcare workers. It makes it a bit more of a valuable profession, one that will be attractive to workers, especially perhaps people who might have thought, I'd go into retail or
Yeah.
into areas like that and think, actually, maybe childcare is viable now.
Yeah.
And that's a very good thing, because one of the other things we know is there's a massive demand for childcare. It is
Yep.
huge. It's not a case of we've got a lot of childcare workers out there going, gee, I wish there was a job for me. Or we've got a lot of parents with kids going, oh, I've got too many options to where to send my child. You know,
No,
oh my
talking to the
gosh.
parents I know, it's
Yeah.
more like, oh dear God, where will I be able to get my
Yeah.
child in? Yeah.
I mean, I remember when we had our first child, we were living in Cairns, and there was one childcare centre that was near where we live, and we thought, oh, this will be good. And when we went to apply a year or two out, they said, no, you probably should have applied when about 6 months before you got pregnant. Then you would have got in. You know, so it's a case
That's
of this
crazy.
is all about helping that side of things.
Yeah.
And that's a good thing, not just for childcare workers, not just for parents, but for the economy overall. So I think a really good move.
Yeah. I assume it will probably be good for our nosediving birth rate as well.
Well, I mean, all this talk about birth rate, big reason why people don't have kids, and you can talk about fears of existential crisis of climate change, and yes, but really what it comes to is, can we afford to have kids?
Most people know,
You know,
my
can we-
age, yeah.
Yeah, and also, well, can we afford a house with the kids? Because you're going to need an
Yeah.
extra bedroom, and also then I can't afford to quit work. I can't
Yeah.
afford. The cost of children is massive, and so things like this are really crucial.
Step in the right
Certainly.
direction.
Yeah, absolutely.
Just going back to the RBA keeping interest rates on hold. So you wrote in your column in The Guardian this week that after the RBA has kept rates on hold, there's also a potential rate cut on the cards by the end of the year, you write. So why are you and other economists, other investors thinking that there is going to be a rate cut?
Basically because everyone's starting to worry that not only Australia's but the rest of the world's economies are all slowing a little bit more quickly than they were hoping.
Yeah.
And it's all about trying to stave off a recession, trying to keep unemployment down. And it's this sense of, inflation, even if it's a little bit higher than it was, it's not at panic stations anymore. We don't have inflation at 6, 7, 8%. It's 3.5%, 4%. It's higher than we'd like, but that's not the big problem right now. The big problem right now is people aren't spending.
Yeah.
Businesses aren't hiring. Unemployment is rising. That's not good. And if that's happening, then you're looking at the Reserve Bank going, okay, what are you going to do about this?
Yeah.
And cutting rates is what they would do about it. And so that's pretty much what's come into play, especially because what we saw this week in America and sort of the reverberations around.
So what would a rate cut mean for your everyday Australian?
Well, the great thing for most Australians is it just overall, even if you don't own a house and are paying off a mortgage, it just lessens the brake that the Reserve Bank has been putting on the economy. So it means mortgage holders, for a start, are going to get a reduction in the amount they have to pay monthly on their mortgage. And that releases an amount of money into the economy that you can spend. And to give an indication of what we're talking about here, our colleague at the Institute, David Richardson, has sort of looked at some of the impact of these rate rises and has seen that basically the total amount of rate rises since May 2022 has led to about an increase of about $212 billion in interest payments.
Is that a lot?
Well,
Billions
put it this
don't really
way,
mean as much in the whole economy
it's
to me.
a heck of a lot.
Yeah.
212 billion is an amazing amount of money, especially, and we're talking annual increase in the annual amount of interest being paid by businesses and households to banks. So $212 billion in a year is a heck of a lot when you think about in a year, the Australian government raises about $700 billion of revenue each year. So in that regard,
That's
it's
a significant
big chunk.
portion. Yeah.
So it's a massive amount of money. And, and you think the government spends about that much each year. So it has a massive break on the economy. Now, yes, that money is taken out of the economy. It doesn't stay out of the economy. The bank is lending it out as well and paying, term deposits, and term deposits are going up. And so people have actually made a bit more money because they've got term deposits, but it's a very uneven cost and benefit. The people who are losing out are generally small business owners, definitely, because their rates go up because they pay a lot of variable rates, in your overdraft and things like that. And homeowners who are generally younger, lower income than those who have already paid off their mortgage and have got high degrees of wealth. And they're the types who are more likely to hold term deposits. So it's a real transfer of national income from younger, lower income, small business owners to wealthy individuals who are older. And so it doesn't cancel out. And so that cost of rate rises is massive. So once they start reducing rates, it's going to ease up things there. Hopefully that means that people have got more money to spend. Shop owners are going to start going, actually, maybe I can hire or you can have an extra shift, or I can hire an extra person and
invest in some things.
And I can invest in things as well.
Yeah. So Michelle Bullock said we probably shouldn't expect a rate cut by Christmas.
Based on what I know today and what the board knows today, what we can say is that a near-term reduction in the cash rate doesn't align with the board's current thinking.
Markets are saying rates should be lower. Have the markets got it right? And is a recession on the way?
What I'm trying to tell the markets today is that I think they're probably expectations for interest rate cuts are a little bit ahead of themselves. Are we heading for a recession? I don't believe so, and the board doesn't believe so.
Why do you think she said this?
Well, yeah, but also, governors of central banks really have to keep their cards to their chest. If she was to say, I think we'll have a rate cut by Christmas, everyone's going, why are we waiting? Why not now? And you're also saying, okay, you've guaranteed it's coming, and financial markets would just go mad.
Yeah.
Really, they have to play it careful. And also, she's right. I mean, if something abnormal happens, we start seeing inflation rising and going well above 4%, she won't be cutting rates.
Yeah.
And so she's got to be careful there. But basically, the market and some economists, certainly us, we're looking at things like unemployment rising. We're looking at weak household spending. We're looking at the fact that the economy has gone backwards 5 quarters in a row when you take into account population growth, and going, things are pretty crap out there. So let's cut rates, and probably you're going to cut them sooner rather than later. So I think that's all the reason she's doing it. There's nothing to be gained from her point of view of guaranteeing it, and she really can't do it.
So raising interest rates has a direct effect of raising people's mortgages. So what does a rate cut mean for house prices and housing? Yeah, this is where it gets a little bit interesting, because you generally think, interest rate cuts, that's great, everyone wins. It's like, I mean, if you own a home, good, your interest repayments are going to be lower. But if you're wanting to buy a home, okay, yes, it's kind of good, because you might be thinking, okay, my repayments if I buy a home are going to be less than I thought they were going to be. But also it means generally that people can afford to actually make these repayments. And so lower interest. Why is that bad?
It's bad because it means more people are looking to buy a home. Yep. And when you got more people looking to buy something of which there is not much of, the prices of that go up. And that actually means in turn, because your interest repayments are based on the size of your loan. So if the size of your loan has to go up 30,000, then your repayments are going to go up even though the interest rates go down. So it's a little bit of a dual-edged sword for things. It's good, but it also means it's probably going to cause house prices to go up, and house prices are already still just rising pretty solidly. Yeah, pretty much they did go down a bit from the absurd surge we saw during the pandemic when we had all the home builder stimulus and we had record low interest rates. They went down, but since the Reserve Bank has kept cash rates steady, they've kind of started going back up again. Now you think, oh God, if there's the suggestion that there's going to be a rate cut coming, that might even spur it on again, and goodbye even better housing affordability. Yeah, I mean, as someone who theoretically is saving up to buy a house one day, maybe, it does sort of feel like nothing will ever make house prices come down. But does it look like, am I completely screwed? Will I ever get a house, Greg? Look, based. It's the old saying of past performance is no indicator of future returns. But if we're looking at the past performance of governments on housing policy, you're screwed.
Oh, great. Yeah,
because,
cool.
We've had 25, 30 years of the total shit show when it comes to housing policy in Australia. And if we keep doing what we've been doing, whether it be on tax policy, whether it be on supply, and we'll get to that, nothing's going to change. And we know when we look at interest rates at the moment, they are actually lower than, say, they were in 2008.
Yeah.
People think interest rates are high, and they are high, but that's high relative to where they've been the last decade. But they're actually lower than they were. And yet, when you look at the cost of repaying your home loan at the moment, it's much harder than it was back then because the total cost of taking out a mortgage has just exploded over the last 15 years. And so even with lower interest rates, your repayments are still much greater as a percentage of average income. And so it's at the point now where really loans are so huge that a household on average income kind of can't afford to have a home loan, and which is just absurd. And if we keep doing what we've been doing for 25 years, sorry, you ain't buying a home, and it's going to be really tough. Housing affordability is just going to keep getting worse. So, things have got to change.
Is this the worst it's ever been in Australia to buy a house?
Yeah, it really is. I mean, there's a bit of fudging. Was it worse maybe a year ago, 2 years ago? But basically, if you're comparing to where things were 10 years ago, definitely where things were 20 or 30 years ago, much, much worse in terms of the relative cost of a house to average income.
Yeah.
Much, much worse than it was. Forget all talk about, we had 17% interest rates in 99. Yeah. But home loan was a heck of a lot smaller than it is now. And it wasn't 17% interest rates for very long. So it's tougher now. And one of the main reasons it's tougher is we're actually building fewer homes. We're building fewer residences now. And this is one of the things I look at in my column. I looked at how many new residents are being approved for building, and then thought, okay, well, that's fine. But while we can compare it with what was the case 10, 20 years ago, population has increased in that time. And so I did it as a per capita basis. And in the past 12 months, the number of residential approvals was lower than it has been for about 11 years. But once you take into account population growth, it's kind of as low as it's ever been.
Ever. Wow.
And even worse is that's also the same for public sector building approvals. We used to, back in the past, back in the 60s and 70s, when our Prime Minister was talking about, I grew up in public housing. Per million people in Australia, each year we built around 1,100 to 1,500 new government-owned houses each year. Now we build about 100 new government-owned houses per million
about
people.
About a tenth.
It's just gone off a cliff, and it went down a little bit during the 70s and 80s. It started massively going down at the end of the 90s and through the 2000s, and that coincided with this period where we also changed tax arrangements that benefited house owners. And surprise, surprise, you stuff up supply, you juice up demand. What happens? House prices go up, housing affordability goes to the floor, and you are where we are now.
So moving away from that incredibly depressing topic about how I'll never be able to afford a house to a slightly depressing topic. There was a lot of chaos this week in the global stock markets.
We begin with breaking news on Wall Street after a tumultuous day for markets across the globe.
The Japanese market has had its biggest one-day slump in yen terms ever.
Stateside, weaker than expected employment data sparked concerns about a recession.
This is really bad news for the Democrats, but it's also really bad news, of course, for an awful lot of people who own shares in America and their retirements and so many workers.
The old saying, when America sneezes and Australia catches the cold, didn't that stack up today?
According to the ABC, the Australian stock market, the ASX, experienced its worst single-day session since 2020. It was down 3.7% on Monday, wiping more than $100 billion from the Australian stock market. Greg, what happened? What the hell happened in the global economy?
Oh, look, everyone, all the stockbrokers were really hepped up on coffee that day or something. No, it all goes back to a thing which we were talking about a couple of weeks ago from memory, where listeners might remember I talked about the US economist Claudia Sahm and her measure of recessions and how if unemployment goes up, essentially if unemployment goes up by 0.5 percentage point in 12 months, that kind of means you're getting into recession territory.
Yeah.
And last week, the US unemployment figures came out for July and they went from 4.1 to 4.3% in that month. And that actually triggered that Claudia Sahm rule of recessions of it having risen by more than 0.5 percentage point in a year.
So everyone kind of looked at that.
Everyone kind of went, freaked out a little bit. Are we in a recession? It was truly, that was it. In fact, the governor of the Federal Reserve said, oh, look, the Claudia Sahm rule is not an economics rule. Like there is somehow this sort of, oh, no, that's not a true economic rule. So we're not in a recession. And everyone's like, yeah, but it's saying that we're going to probably be in one. Shouldn't we be worried about it? And so basically everyone panicked. America panicked. The Japan stock market panicked because Japanese investors often borrow a lot in Japanese yen because interest rates there are really low and they invested in American companies. So if Americans going bad, they go bad. And Australian investors look around and go, oh, might be a good time to sell. It seems like things are going backwards. But let's just all get a bit calm. Yeah, worst day since 2020. Don't worry. The stock market in Australia, as of recording, is still higher than it was a year ago. The Japanese stock market is about 4% higher than it was a year ago. Same in America. Look, the stock market does go up and down. For most people, this is going to be meaningless. Yes, you've got money in shares through your superannuation, but unless you're going to retire tomorrow, you won't even be remembering this day come, when you hit 67 and you start retiring. Stock markets go up and down. What is more important here is that this is signaling that everyone has realized that maybe the soft landing of being able to kill inflation through higher interest rates, and in America, interest rates went higher than they did here in Australia, and some economists were like, oh, look at what America's doing. Australia should be doing that too. We need to be tough.
I don't know that we need to copy America
and
necessarily.
Now everyone's going, oh, yeah, when you raise interest rates, the economy slows and sometimes could go into recession because, well, we did that in the 1980s and it went into recession. We did it in the 1990s, it went into recession. It's generally what happens.
Yeah.
And I think everyone's just got a bit concerned here. But the good thing about it, and this is, again, why an interest rate cut is more likely, is that reserve banks, central banks are very aware of this. Most of the economists who are now heading the reserve and central banks around the world were in their early parts of their career in the 1980s and 1990s, where they experienced massive, deep recessions because they had raised interest rates so quickly and everything kind of went kaplooey, technical term. So they're very mindful of that. And so I think that's what we saw today was everyone just a bit of a wake up.
Yeah.
We were going around saying soft landing, everything's going to be cool. When everyone's like, have you actually seen the economy? Have you seen that unemployment's rising? Have you seen that businesses are saying we ain't hiring?
Yeah, not so much of a soft landing as a crash.
And we've been doing this. We've been talking about this in this podcast. We've been saying all these things, saying all the data's kind of saying things aren't that great.
Yeah,
and now it was almost a case of the market. The investor was going, yeah, things aren't all that great. Maybe the Reserve Bank's got to have to do something about it. And so I think that's what we saw. Yes, it went down. It had a bad day. It's kind of flattened out, and everyone's sort of taking a bit of pause. The Japanese market has recovered a bit. These things happen, but it wasn't like a stock market crash of what we saw in, say, 87 or what we saw during the GFC. It's just more of a correction, and hopefully if governments and central banks wake up to the risks of recession, things will get back to normal.
So just keep calm and carry on for the moment.
Yeah, keep calm and carry on, and really don't worry about panicking when you see the stock market index. If you ever watch the news, it doesn't really matter to you too much.
All right, that's probably about all we've got time for today, Greg. Thanks so much.
No worries, Elinor. Next week, we are going to have, of course, another dollars and cents, and there is a lot coming next week. The big one being the latest wages index, where we're going to get a real sense of how wages are growing. that will have a massive impact on interest rates, because if it's higher than expected, all that talk about a rate cut by Christmas might go out the window. So tune in then. But thank you everyone for listening. As I say, we will be back next week. This episode of Dollars and Cents was recorded on Thursday, the 8th of August, and some things may have changed. You can find my column, which is looking at all the data on interest rates and house prices, in my column, Grogonomics, on the Guardian Australia site. And for more research looking at what is actually driving inflation and the cost of interest rate rises, go to our website, which is at australiainstitute.org.au. My Twitter handle and the handle I use on Twitter and Threads and all social media is at GrogsGamut. And Elinor's is
at Elinor J_L, Elinor spelt Elinor.
And remember, if you've got any questions, please send us your questions. You can email us at podcasts, with an S, podcast plural, at australiainstitute.org.au, or you can just hit me up on Twitter or on Threads somewhere, and I'll be sure to see if I can answer it. Our theme music is from Blue Dot Sessions. Everyone have a great week, and we'll see you all next week.
See ya.